So in the previous video, I showed you permanent rate buydowns where you can pay a one-time fee and get a permanently lower rate. Well, this video, I'm going to share with you what a temporary buydown is, or a 2-1 buydown, or a 3-2-1 buydown. You may have heard this terminology and might not know exactly how this works. Well, I'm going to explain to you how this works and why you would want to do this instead of a permanent rate buydown. Okay, so let's say you found a house and your price range, you're looking at $300,000 home, and you want to maybe make an offer on this house. You look at the house, you're like, hey, Mr. Realtor, I really like this house. Home's listed for $300,000, but hey, I want to offer this seller $285,000 instead of $300,000. So you're looking to get a deal, looking to get a little bit of a price break on this house, which is great, no big deal. And if you got an accepted offer at $285,000, your payment would go from $2,600 from $300,000 down to $285,000. Your payment would be $2,400 and some change instead of $2,600. So you'd save about $130 per month. Well, instead of asking for a price reduction, what I might consider doing instead is asking for a seller credit. And you can take that seller credit and do what's called a 2-1 buydown or a 3-2-1 buydown. So that is this third option right here. So you'd keep the price the same, and then you're going to ask for a $15,000 seller credit to help you cover closing costs and this 2-1 buydown. So how this works, the seller is going to give you this $15,000 credit. And so you can see here your cash to close is cheaper, $8,000 cheaper. And then the other $7,000 allows you to get a lower interest rate that first year. You actually have a lower interest rate at 5.5%. The second year, you have an interest rate at 6.5%. And then the third year and every year after that, it then goes to 7.5%. Now, it's a 30-year fixed at 7.5%. It's just the first 2 years you get a discount or you get a lower rate. You can see here the first year you're at 5.5. The second year, you're at 6.5, and then the third year and every year after that, all the way to year 30, you're at 7.5%. And you save $387 a month, so your payment would be $2,200 instead of $2,600. So the first option with the price cut, your payment would be $2,400. Well, utilizing the same amount of money, that same amount of price reduction, you're getting a credit to actually save on your monthly payment. Now, the beautiful thing about this temporary buydown is that $7,100 that it's costing you to get that lower rate for the first 2 years. If you sell the house or if you refinance the home, whatever's left in this account, this is your money. They hold this in an account to help you cover the difference in payment to keep that lower rate the first year and the lower rate the second year. If you sold or refinanced the house, whatever's left over comes back to you. So you can use it to pay down the mortgage, you can get a check, or you could actually use it to pay closing costs on your next refinance loan. The beautiful thing about this is it's very different than the permanent rate buydown. If you remember in the previous video, the permanent rate buydown, if you were to refinance after 1 year and rates drop, you lose all that money that you spent to buy down that rate. Where here, all this money, it's still yours no matter what. So you actually get to keep this. So in this example, you save $387 on your payment that first year, and your cash to close is only $12,000 instead of $20,000 because of this $15,000 seller credit. Now, you can also do what's called a 3-2-1 buydown. And what this is, it actually lowers your payment 3% the first year, 2% the second year, and 1% the third year. And so what that looks like is, here's your first year, 4.5%. The second year, you're at 5.5%. The third year, you're at 6.5%. And then the third year and every year after that, you're actually at 7.5%. So it's going to take 3 years to get to that 7.5% rate. And look at this, you actually save about almost $567 per month from the $2,600, and you're utilizing the same seller credit of $15,000. Now your cash to close is exactly the same as what it would have been if you didn't ask for a credit, or if you got a price reduction. Cash close is the same, and your payment's a lot less those first 3 years. Obviously, the 3-2-1 buydown is more expensive because you're saving for 3 years instead of just 2 years. But this $14,000, if you were to refinance after 1 year, 2 years, you'd have money left over and you'd actually get that back. So it's a great strategy. It's a really good strategy. A lot of buyers use this. The cool thing about this product is you can actually utilize this with a first-time home buyer loan. So you can actually do a 2-1 buy down with a down payment assistance loan. I can explain and show you, me and my team can show you how this works.